Good morning, everyone, and welcome to the LSOY Advisor webinar, Deferred Taxes. Your balance may not be what you think, brought to you by the Illinois Soybean Checkoff. I'm Emily Carls, and I will be moderating the webinar today. I want to thank you for taking time out of your busy schedules to join us this morning, and I have just a few housekeeping items to begin with. If you included your CCA number when you registered for this webinar, and you stay with us for the entire presentation, your number will automatically be submitted for one CEU in professional development management at the conclusion of the webinar. If you are listening to a recording of this webinar, you will need to go to the Certified Crop Advisor website, log into your account, and self-report for credit. You can ask questions during the webinar by using the tools panel at the bottom of your screen, and we will have time for Q&A at the end of the presentation. This presentation is being recorded and will be posted on the Checkoff funded website, illsoyadvisor.com, along with a copy of the presentation slides. Without further delay, I'd like to introduce today's presenters, Dick Whitman and Todd Doring. Dick is a former manager and board chair of a 20,000-acre Idaho family farm partnership involving crops, cattle, and timber, and provides consulting services in family farm business and financial management in the US and abroad. A former FCS lender, Dick has served on numerous commodity and financial institution boards, is a director and past president of the Farm Financial Standards Council, and past president and founding member of the PNW Direct Seed Association. He is also an adjunct faculty member of Texas A&M University, teaching annually at the TEPAP Executive Program in King Ranch Institute. Todd Doring is a director of Centrec Consulting Group, LLC, and has been with the firm since 1991. Centrec has worked extensively in the food and agriculture sector since its founding in 1983, including considerable research activities with producer groups, data analytics, and quantitative economic analysis. During his professional career, Todd has led numerous projects and activities, including development of analytical tools and models, financial and economic assessment, data analysis, modeling and visualization, economic and market analysis, strategic planning, value chain analysis, client advisory roles, project management, educational program development, and delivery of classroom-based training. Todd also holds a bachelor's and master's degree in agricultural economics from the University of Illinois. And with that, I'll hand that over to the both of you.
Thank you, Emily. It's a pleasure to be with everybody today. Dick and I are going to tag team this, so I'll just go through a couple introductory slides and then turn it over to Dick. So in the PowerPoint that we're using, you should have a PDF of that. And today we're just going to do a real quick overview of the council. So we have a couple slides here about the presenters, and then just one slide on who is the Farm Financial Standards Council. And then Dick will talk about the deferred taxes, giving an overview, and then I'll walk through a few examples. So I'm going to skip through these bio slides. So about the Farm Financial Standards Council, it's been around for a while. Began in 1989, right on the heels of the 80s farm crisis, as that was kind of working its way out. There's actually a long story that we won't go into today about how that came about, but the council was asked essentially to come up with some underwriting standards, and it was comprised of a whole host of people who were strong-willed and independent and said, we're going to come up with some guidelines on how we should analyze financial statements for agriculture. So that has been going on now for 32 years, strong, robust group. And the primary mission is to develop standards for preparation and analysis of agricultural financial statements. So that's kind of our key mission. We have a couple of different guidelines that we issue. They're available on our site, which is ffsc.org. Kind of thick, but in a nutshell, the council acknowledges that GAAP is the ultimate goal for preparation of financial statements, but acknowledges that agriculture is really not able to get there quite yet. And so because of that, there are a number of different recommendations that are made. Today, the council is comprised of 150 members across the US, including producers, accountants, lenders, a number of folks in academia, farm management extension agents, software developers, consultants, and it's likely I've left people off on that. So a large group, and our continuing efforts are to keep the guidelines current and relevant to agriculture. And I would encourage you to go to the site ffsc.org to learn more about the group. It's the work we do is all based upon a bunch of volunteers, and anyway, it's been well received. So with that, I'm going to turn it over to Dick Whitman, and Dick, I'm going to mute myself, but I'll advance as you tell me.
Okay, thanks, Todd, and thank everybody for joining us today. You want to move to the next slide? Todd and I are going to collectively cover many of the issues on this slide, starting with what's the difference between cost and market value. Why is it important to know? There's a number of issues right now where this has probably been never more important than right now to know the answers to what we're going to talk about today. If you're trying to do annual tax planning, if you're considering business expansion, if you're in the process of updating your estate planning or doing succession planning, understanding your basis in your assets versus book value versus market value is critical. If you're in the issue of a business transfer or a buyout, knowing the difference between these values is critical, because oftentimes we're seeing people with an inflated idea of what a business is worth when they're not recognizing tax liability. So in a nutshell, if you're looking at your net worth, how much of your net worth has been realized and tax has been paid on that net worth versus how much of your income, your net worth, is deferred income or valuation equity. We'll go into more depth on the definition of these two terms. And then how do we calculate the deferred tax and the estimated tax liability, and where do we put this data, and how do they impact the accrual adjusted income statement, and how does this information impact the net worth reconciliation? Next slide. So this is an issue that I've personally been dealing with both on our farm operation clear back to 1980. In the late 70s, Tom Fry and Danny Kleinfelter came out what we called the Little Red Book, where for the first time, the ag finance industry and the financial analysis industry started having a more concrete process to look at cost versus market value on a balance sheet. Most farmers and most ag lenders had a single column balance sheet that was a mixture of, very seldom was it true cost, nor was it true market. And this gave us the first chance to look at, all right, you might show a $10 million net worth on a market value basis, but on a cost basis, when you considered your depreciated assets and what you actually paid for land and equipment, you might have a cost basis of $4 million and a market value of 10. So there's $6 million of difference there that really Uncle Sam has got a bite of that before you can ever realize that is true net worth. And so there's kind of two different levels of unrealized gain, and I use that term somewhat liberally. There's the difference between your current assets and liabilities and the difference between tax basis and book value on machinery and equipment buildings. And that difference is deferred income, which results in a deferred tax and will result in an adjustment to your accrual net income. And Todd will go into more detail on what these actual numbers in an example later. But there's two different kinds of unrealized gain. And so the second, you want to move to the next slide. The next level of differentiation is the difference between your cost or book value and the market value of your assets. So let's take, for example, you had $1 million of equipment, and using rapid depreciation or accelerated depreciation, maybe you've written your entire equipment line off, so your tax basis is zero. If you're using book value depreciation to show a more realistic assessment of what your true depreciation is from year to year. Maybe you had $1 million of cost and maybe $600,000 of accumulated depreciation. So your book value might be $400,000. If you had a current appraisal done of your equipment line, it might appraise out at $800,000. So the difference between book and market is what we call valuation equity. And that's not equity that is recognized as accrual income. It's a part of your net worth that affects the reconciliation net worth. So this may sound a little bit technical, but this will make a little more sense as we work into the actual examples. Next slide, please. So I've been a strong advocate that farm businesses, oftentimes, let's say you're a partnership situation and you get a K1 that shows your book capital at the end of the year. That simply shows the portion of your capital that you have recognized for income purposes and goes into your K1 as your capital account. But if you completed a balance sheet for that operation, the total net worth of that business might show at $7.2 million. And the difference between your book capital and your total equity position is unrealized gain, which is a combination of both deferred income and valuation equity. So if you look at this, in this particular case, 43% of each of these partners' equity is not been recognized for its potential tax liability. So you can't really say my net worth is $7 million because under current tax laws, it could be that if you died and you got stepped up basis. But as a going concern, if you were to sell out or do a buyout, you would have to recognize the tax liability on this $3 million. Next slide. So there are a number of things that contributed to deferred income and deferred tax. The difference between the carrying value of your assets over the tax basis. So anytime you have current assets that are on the books that are most likely have a zero basis, like commodities, accounts receivable, prepaid expenses, because on a cash basis for paying taxes, you've written them off. But when those assets are liquidated, they create a taxable event. On the flip side, any deferred expense items where you're recognizing that you owe them, but you've not paid them, the act of paying these items like accounts payable, accrued interest, property taxes, would create a deduction from income. And so these would tend to reduce deferred income and also reduce deferred tax. So things like estimated federal and state income taxes and payroll taxes, any unearned government payments are all forms of deferred expense. Many years ago, when we could take advances on government payments, it was very common for people put that into an income stream in the current year, but it had to show on the balance sheet as an unearned government payment. We don't see so much of that anymore. The final category, and this relates to more breeding stock, machinery, equipment, buildings, and improvement. The difference between your tax basis and your book or base value of these same assets results in deferred income. So these are the kinds of things that would be contributing to a calculation for deferred income and deferred tax. Next slide. On the valuation equity side, if you think of your business as having 3 balance sheet columns, the first column would be tax, the second column would be book value, and the third column would be market value. Now we're looking at the difference between the second and third column. What's the book value of my machinery and equipment versus what is its market value? What's the book value of my farm real estate versus the current market value? And that difference is known as valuation equity. Many of you who use computerized farm accounting software, you have a tax basis that reflects one set of numbers. And then when you put in your market value data, most of your software programs will actually calculate a number called valuation equity. And in a lot of cases, that valuation equity is not just valuation equity, it is a combination of deferred income and valuation equity. Next slide. So as I said, in the perfect world, we should have 3 different sets of data: our tax or cost basis, our accrual book values, and then our market value balance sheet. And once we have those 3 sets of data, we are in a position to fully understand how much of our net worth is deferred income and how much of it's valuation equity. Next slide. There's been a lot of debate on the council over the years as to where deferred tax should be recorded. And those progressive farmers that are following good progressive accounting and financial presentation practices would calculate this data and put it on their balance sheet. Lenders oftentimes would come back and say, well, it's not a debt that needs to be serviced. And so if we put it on your balance sheet, it will increase your debt asset ratio and it will lower your credit scoring. So oftentimes lenders remove this, or farmers are encouraged to take it off. I found a convenient alternative is to do the calculation at least included in your footnotes. If you want to be academically perfect, go ahead and show it on your financial statements with proper disclosure to lenders that you're not going to be comparable to other businesses in a peer group comparison if other businesses don't follow the same practices. Next slide. So I'm going to hand this over to Todd in a minute, but over the last couple of years, the Farm Financial Standards Council has been working extensively on how to provide a better set of information on how producers should deal with both deferred tax and estimated taxes. And so I'm going to turn this over to Todd, and he's going to review the current guidelines that are in development in some samples. So it's all yours, Todd.
Hey, thanks, Dick. I appreciate that. So Dick's kind of given a broad overview of deferred taxes, why they're important. So I'm going to walk through some examples. And the examples are taken from the guideline that I held up just a little bit ago. Again, you can get that from our website, but it's called Financial Guidelines for Agriculture. And it walks through a lot of the conceptual issues that we're talking about here, and then provides sample financial statements as well. And just to kind of summarize where we're headed, we really have these 3 different components of deferred and estimated income taxes. The last slide that Dick talked about, it showed 2, and we'll get into that in a moment. They show up 2 places on our balance sheet, but we really have deferred taxes of current assets less our current liabilities. That will affect earnings. We have the deferred taxes of book tax differences on machinery and equipment, buildings and improvements. Those are the predominant ones for those of you that raise breeding stock. It would also include that. And then so those first 2 items though relate to our income statement. They'll generate a deferred income tax liability. The last component here is estimated income taxes from valuation equity. That's the differences between the market value of land and machinery less the book value. Those are generally the largest items. Those are generally significant. In the example that Dick was talking about, the bulk of the deferred and estimated income taxes relates to this last section. So I'm going to go through some of the statements that are in this Appendix A, which Appendix A of our guidelines walks through a set of financial statements for a farmer that prepares their books on a cash basis and then generates a market value balance sheet at the end of the year. And we go through the computations to generate an accrual adjusted income statement. And so I'm not going to go through all of those details, but just focus a few of the comments here specifically related to deferred taxes. Now I realize that it's kind of small here, but I want to focus in on really this highlighted box, which is on the liability side of our balance sheet. So we're showing 2 years of numbers here for this operation. And what you normally are probably familiar with is what you see at the very, very top of your screen, business income tax liability. And so that's the amount generally that you would put on the balance sheet at the end of the year that would then be paid when you pay your taxes in March or April. And so that is what we generally are familiar with. That's what we tend to see. That's what's on, that would be the number that would be on most balance sheets. So what we are talking about here are these deferred income taxes. And then we've introduced a new term in the last year called estimated income taxes, which is that portion that really focuses on the valuation gain. So the deferred income tax, the first item that you see there, when we put that liability on the balance sheet, it's about 200,000 in the X7 year, and it's about 230,000 in the X8 year. So the increase there is almost $35,000. So our liability, that if we were to sell, right, liquidate our current assets, and then this also incorporates the differences between book and tax, that's going to lead to an extra $35,000 of income tax expense. Not that it's going to be paid, but of expense related to the current year's production. The other component, this estimated income tax, that's really, again, relating, generally we talk about the market value of land versus its book value, because that's 80% of that value usually, but it can also include machinery, market versus book. But it's generally land, and you can see that value is 430,000 in the first balance sheet and about 460,000. So that number went up about a little over $26,000. So it's important to note that second number, the estimated income tax, does not affect our earnings. That number, it shows up on what we'll talk about in a minute on our statement of net worth. But the first number, the deferred income tax, will affect reported earnings from the operation. Let me go on to the income statement. You'll see both of these numbers come up as we go through these other statements. So, and I really realize you can't see this statement here. This is the income statement, and I want to just zoom in on the income tax section near the bottom. And so the top part of this is bringing in revenue. It's bringing in our cash and accrual adjustments. It's bringing in our expenses and accrual adjustments. And we are getting, at the very top of the page, you can see our income from operations of about $175,000. And then we've got our interest, et cetera. And then the very bottom here, we've got our income tax expense. So the income taxes on the first row, that is the amount that was on the balance sheet. That's the amount payable that we will pay. I'm sorry, that's the amount that was on our first balance sheet that we paid this year. And then this increase, decrease in accrued income taxes, that was that amount, that green shaded amount a couple slides ago. That's the difference there. So the sum of those two represent our accrual earnings on this $136,000 that you see that this farm earned. The bottom line of this section here, increase, decrease, and deferred taxes, that is the amount that's hitting the income statement. And so I've brought in those two components from the balance sheet from the previous slide, where we saw it was about 200, technically it was 197,000 in X7, and in our current year it was almost 232,000. So that increased during the year. Our tax liability went up by about 35,000. So that income tax expense goes up, and therefore we have roughly $48,000 of income tax expense flowing through the income statement. So an important point to make as we go through this is really considering that, you know, what is the definition of a balance sheet, or what do we want to show on our balance sheet? And GAAP would tell us that balance sheet should represent what we own and what we owe as of a particular date and time. And so Dick alluded to this earlier. We may not plan to liquidate, but if we were, what would we owe? And so that's what we're trying to get to with our deferred tax and our estimated income taxes. So that I talked about the balance sheet, the income statement. I want to talk about the statement of net worth, which brings those two different components together. And when I'm done with this, then we'll actually walk through the computations of this briefly, just so you can see how that all works. So on our statement of net worth, this is a really important statement in agriculture because it's reconciling market net worth from one balance sheet to the next. So it's bringing in how much we earned on an accrual basis. It's taking out things that are not a deductible expense like withdrawals. And then it also brings into account how much valuation equity we have. And so you can see the first yellow, in the yellow shading, that first row, which is kind of a long name, but it's essentially valuation equity, the change in it. So it's the excess of the market value over the book or base value of our non-current assets. So how much did that change from X7 to X8? And in this case, our valuation equity went up 107,000 almost, or think of it this way, we increased the value of our land roughly $100,000. The market value went up. We didn't buy anything, we just increased the market value of that. Well, if that were to be the case, there would be a corresponding increase in the estimated income taxes that would have to be paid upon liquidation. And so that number is almost 27,000. So we remove that and we get this total change in our valuation equity as a net number of about 80,000. And normally what we see in agriculture is an absence of deferred tax, an absence of this estimated income tax. So we would not see the net numbers, we'd see the gross numbers, which is, as Dick talked about earlier, potentially over-reporting our true equity at the day, as of the day of the balance sheet. And here are the numbers from that balance sheet. So you can see that in X7, we had about $433,000 of valuation equity, and and about 460,000 at the end of X8. So that was about a $27,000 increase. That number does not affect our earnings. It's just reducing the amount the net amount that gets reported related to valuation equity. Okay. Now in our guidelines, we have a complete set of financial statements, including a lot of balance sheet schedules. And one of those schedules walks through the computation of deferred taxes. And so what you're looking at right now is that schedule. And again, I realize it's small, but we're going to walk through that in different pieces. But we essentially have three components. So we keep talking about these three pieces. And so it's organized accordingly. So we have this first bit, which has got this label net realizable value tax differences. That's, for all intents and purposes, our current assets minus our deductible current liabilities. And on this, we then apply an estimated federal income tax rate. We then have SE tax as well. Our next component is differences between book value and tax value. And so this is the second component, but it's additive with the first. And so you'll notice at the bottom of this section, that $231 value right here, this value, and the beginning value. Those are the numbers that show up on the balance sheet, and the change in this is what affects our income. But it is really, there's kind of two ways, there are two components that we use to compute it, right? The first is this section here on current assets and current liabilities, and the next is on our non-current assets, book tax differences. And then our third section here is the valuation equity component that we're talking about. And here's where you'll tend to see larger numbers. And again, I'm gonna go to the next few slides because we're gonna zoom in on each one of these sections. So here I've just expanded this top, really the top half of this, which is the first portion of this schedule. I've just expanded the whole schedule here. And so again, I'm not going to go through all of this in a lot of detail, but what we are showing here would be our deferred income items. So these are going to be assets that we're putting on our balance sheet, but we don't have any tax, well, for most of these, we don't have any tax basis. So upon liquidation of those, when we sell those inventories, when we receive that accounts receivable, that's going to generate taxable income. And so you can see the items that we have here. Dick mentioned these items. Some of these are a little bit perhaps nuanced. Cash investment in growing crop, that's the amount that we've put into our crop. At some point, we will harvest that, it will become inventory, and upon sale will be deferred income. But at this point, we're trying to say how much have we on our balance sheet that would be taxable. You'll notice we have a tax basis in our hedge account equity, so that gets removed. But essentially, we're saying what's the value on the balance sheet minus the tax basis. And so you will see that in our X7 year, we had about 221,000, almost 222,000 of we're calling this excess carrying value over our tax basis. And in the X8 year, it was about 267,000. So that becomes our deferred income. We then have a few items that we will deduct, right, in the next year. So our accounts payable and our accrued interest, we will pay those in the subsequent year. Those will be deducted from our deferred income. And so you can see those are smaller amounts in this case, but we end up with net income subject to income tax. So if we were to liquidate everything on the balance sheet, then we're saying we would have about $230,000 of net income if we would liquidate everything in our current asset and current liability section. We'd have about $230,000 of net income. Now we are estimating a federal and state income tax. And so part of the challenge of doing deferred taxes is estimating your marginal tax rate. And so I believe in our example, we're using a 25% federal and a 5% state. Obviously, it matters where you live, it matters the tax bracket that you're in. But for this operation, this would result in roughly $69,000 of estimated federal and state income tax upon liquidation. We also, though, need to compute SE tax in the case for most operations that aren't a C Corp. They're going to have to pay SE tax. And so in that case, we have a cap on at least a portion, that we have a cap on a portion of that. But then the whole amount is subject to the Medicare component. So anyway, we end up with an extra 22,000. So liquidating our current assets and current liabilities is going to generate income, which is going to be roughly about a $91,000 tax liability. This number itself does not show up on the balance sheet. Okay, it's one component of our total deferred tax. So let me go to the next page so you can see that. So on this, now we're in our second component of the three for computing deferred taxes. And here you'll notice we have 4 non-current assets. We've got 2 for breeding stock, machinery and equipment, and our real estate and improvements. And here we have what's called our book value. So that's the amount that we have that on our books. Now, why would that differ from our tax basis? Well, for a number of reasons. First of all, for a tax basis on breeding stock, we have no basis in raised because we deduct those expenses. On our book value, we generally accumulate costs or we assign a base value. For purchase breeding stock, we generally have different depreciation rates, and the same goes for machinery and equipment. The differences here between the book basis and tax basis here is minor. We generally often think those are the same. This could likely have to do with some depreciable improvements on that real estate. But you can see here that these differences, I'm not saying they're small, but relative to what's going to be on the next slide, these are not that huge. We've got the biggest component here is the fact that we've been able to depreciate our machinery much faster on a tax basis than we do on our books, right? On our books, we're probably depreciating this more normal, according to more normal use. On a tax basis, we're taking advantage of accelerated methods. And then all of our raised breeding stock is taxable. because we have no basis in that. So we sum those up. We're using the same federal and state income tax estimate here of 30%. So you can see the tax liability of 141,000. It gets added to the value from the previous slide. So let me go back just one moment. So the very bottom number here of 90,985 plus our 190 gets us to this 231. This is the amount that shows up on the balance sheet. This is the amount that results in an impact on our earnings, the change in these amounts here. Okay, the last component is this market book difference. And so you'll notice we have the same four non-current assets: our raised and purchased breeding stock, our machinery and equipment, and our real estate and improvements. But what you'll notice now is the book base values are here, which were on the previous slide, but we also then have a column called market value. So now we're saying, all right, if what we're estimating what the market value of our breeding stock, our machinery, and our real estate would be upon liquidation. And then we're now saying, okay, that amount is going to be a gain, a capital gain. For many of these, it'll be a long-term capital gain. And we sum that up, and you'll notice that the big component here is our real estate. So generally land, we've got about $1.4 million of what we would say valuation equity here, the market value over what we're carrying it on our books at. So we sum all of those up, and we have about 1.8 million in our most recent year. We're using a 25% capital gains tax rate and resulting in about a $460,000 estimated income tax payment if these assets were sold. Okay, this number does not affect earnings. I know I've mentioned that earlier, but it's just an important point to make. Just want to be sure that that's clear. This number allows us to reconcile our balance sheets to our statement of net worth, and it actually lowers our net valuation equity. Okay, and the items that I'm walking through right now, and by the way, we are getting near the end of all of these numbers here. We have an Excel form that we're going to make available as well that you will be able to download after this is over. So all the computations are automatic there. But this bottom section of our estimated income tax worksheet is really just bringing in the total value. So it's bringing in that first portion based upon current asset, current liability differences. The next section is our book tax differences. We care about the change, and this 35,000 is that number that we keep seeing that shows up on our accrual income statement. We then have the valuation equity component of 26,000 that shows up on our statement of net worth. So the total increase in our tax liability from deferred and estimated income taxes was 61,000. Roughly 35,000 will lower earnings, and about 26,000 will lower our valuation change. Now let me just go over this slide here, which kind of summarizes the magnitude of these numbers, just so we get a perspective for how much we're talking about that our balance sheet will be affected when we put deferred taxes on the balance sheet. So these numbers, again, all tie to values that we've referred to previously. But here's our net deferred income subject to income tax. It's about 230,000. That's the current asset minus current liabilities. That's the amount that we applied our 30% income tax rate on, as well as our SE tax. We then have our net income subject to our income tax from book tax differences. This is largely, in this example, raised breeding stock and our machinery differences, right? Because we can accelerate the depreciation on that machinery. And then the last portion here is the valuation equity. But I want to draw your attention to that total bottom line number. We are essentially putting $2.5 million of income subject to, or we're saying that is the amount that is subject to either deferred tax or our estimated income tax. Now, the amount of tax is summarized down below here. So we roughly have 90,000 related to our current assets, 140,000 related to our book tax differences, and about 460,000 related to our valuation equity. So we sum those up, and that's almost, not quite, but almost $700,000 of liability that we're going to put on the balance sheet. So putting deferred taxes on our balance sheet doesn't affect the asset side, but it does affect the liability and equity. So if we're going to put $700,000 of liability on our balance sheet, and we're not going to affect our assets, our equity is going to come down by $700,000. So that's an important distinction to keep in mind. It actually ties back to Dick's comment earlier that lenders sometimes ignore this because their underwriting standards were not written with that in mind, and that significant of a change to your balance sheet can really change some of the metrics that lenders will be looking at. So we think it's a good number to put on the balance sheet because it's showing us what we really owe as of that date, and they're generally sizable numbers. So a couple slides to wrap up this, just showing an example here, but this slide is showing the effect of the process of putting deferred taxes on a balance sheet. So here you can see the first column is showing the total amount of net worth. So we have about $3.3 million of net worth on this balance sheet before we take into account deferred taxes, and we have about $820,000 of liabilities. When we add our deferred taxes, our net worth drops by about $700,000 and our liabilities go up about $700,000. So that's a pretty significant change to the balance sheet. Same operation, same repayment capacity, but it is a huge change in the overall leverage of this operation. Another way to look at it, essentially the same chart, except here, looking at these in terms of percentages. So in the first column, we're essentially showing that our liabilities as a percent of our total assets is about 20. And then after we put deferred taxes on, it not quite doubles, but almost. It goes up about 1.9 times. So it goes up to about 36%. So these last two slides kind of show you the overall magnitude of this, how big the impact on liabilities and equity putting deferred taxes on your balance sheet can be. So this form that you see here, we have an Excel file that we will make available for those of you that are interested. Here is an example of it. You can put in the numbers. It's an exact image of exactly what we just walked through. As you put in numbers, it will automatically calculate all the way through. I should note that these values in here are from the 2018 income tax year. So you would want to change, for instance, the self-employment cap rate. Right now we're just showing 1 year, but you can expand the columns here if you want to show both years, and then you can measure the overall change. But anyway, as you fill that out, you'll get the resulting numbers, and at the bottom you'll see the overall summary numbers as we put these items in. So that will be available. It's just been posted to the chat window if you're interested in downloading that. And I think we're nearing the end here. So let me just go over these conclusions real quick and then open it up to Dick, see if he has any comments, and then we'll do Q&A. So based on the definition of a balance sheet, which is a listing of all of our assets owed and all of our liabilities owed as of a particular date, ideally that would be a calendar year end. I mean, it needs to coincide with our tax year for what we're doing here, but that would, and for most operators, they're going to do that at the end of the fiscal year. Many in agriculture, that's calendar year. But based upon that, deferred and estimated income taxes should be included on our agricultural balance sheets. The important point to note, though, is there's no impact on liquidity. And this is a fairly recent change made by the accounting powers. The Financial Accounting Standards Board made this change, I don't know, 3-4 years ago. There used to be a current portion of deferred tax as a non-current. Now everything is shown in the non-current portion of the balance sheet. So deferred taxes do not affect our liquidity, but they can greatly impact solvency. So it's just an important thing to note. The operation hasn't changed, but we're arguing that we're showing a more complete picture of what this operation would have in the event of liquidation. It does affect profitability because it's matching our income taxes owed, and the income earned. And so it will reduce our profitability, right? Because we're bringing those deferred items, we're bringing the income on those deferred items into the current income statement when that was earned. Just a quick minor note, sometimes that can result in a negative change in our deferred income taxes, right? If the amount that we owe goes down, it can be an income tax reversal. So that does happen, especially when we're in a time period where prices are going down. Unlike this year, that can happen. And this is really, finally, it's a really critical issue for estate planning, retirement planning, and business valuation. So we really know how much we're going to get in the event of a liquidation. Dick alluded to that earlier. So Dick, I don't know if you have any final. See if you do.
I guess one quick thought is I've been doing family business consulting and a lot of transition consulting over the last 40 years. And this is one of the single biggest voids that farmers do not have on their radar screen. And oftentimes people, they start going into an estate planning or a retirement planning, and they've been deferring income for years without any real recognition of how much tax liability is accumulating. And had they known that information 5 years before the decision to retire and had good opportunities for their professional advisors to work through that, they would have had a much more optimal set of strategies to follow. And I can't tell you how many times people have gone in with the financial information and their advisors said, you can't retire. You have all this unearned income, untaxed income. The things that you want to do for your children are not going to work because of your tax situation. And now with these proposed legislative changes on the horizon, the proposal to eliminate stepped up basis, the proposal to eliminate 1031 exchanges, the reduction in the estate tax exemption, these are potentially catastrophic impacts on agriculture that everybody should be screaming at Congress as to the impact on ag. But you can't scream unless you have the data. And if you work through this spreadsheet and you have your own farm data, you have a sense of what the impact of your business could be. And imagine that you went through this exercise and for the first time computed the difference between your market value and your real estate and your tax basis, and were forced into paying tax on an unrealized gain on your ag assets. This is, in my opinion, utter insanity. But we can't just scream up and down and say this is insanity. We have to have facts and figures to go to the people that we've elected in Congress. So I can't emphasize the importance of this, to know where you are for your own business right now.
Okay, thanks, Dick. Emily, I think we're ready for some questions.
Yes, thank you guys for your presentation today. So we did have several questions come through in the chat. This first one is one that Dick already addressed, written in the Q&A function, but I'm going to ask it for the whole group in case people didn't see it. And that is a further explanation on the difference between book and tax basis for machinery and other non-current assets. I think there's another one that also asks specifically about the book value of raised breeding livestock. So you might be able to wrap those two into one.
So most farmers are used to having a tax-based depreciation schedule. And it basically allows us to use accelerated depreciation models to write off almost all of our asset values for tax purposes. But that is a meaningless number for analyzing income performance in a business. So a good business practice farmers are advised to follow is to have a dual set of depreciation schedules. One is tax basis and the other is called book, or oftentimes, if you think about it as your economic depreciation schedule, or you look at your cost, what your projected years of use is, what the salvage value is, and you do your best to project how much that equipment or building and improvement item might go down in value over the life of the asset. So that difference between tax and book is a significant difference for many farm businesses who have been rapidly writing off equipment. And so if you're using tax depreciation, you're understating your true accrual income. So the only way you can get a realistic accrual income is to adjust that back up to book basis or economic depreciation, which is a more realistic chart of earnings. And that same concept applies on breeding stock. If you bought breeding stock and you depreciated bulls or breeding heifers, for example, in a dairy herd, you have a cost, you have a depreciation schedule. And for tax purposes, you may be writing them off very rapidly, but on a book basis or economic basis, you have a much lower level of depreciation. And that difference is what Todd is showing here in this schedule as the difference between tax and book.
So Emily, just real quick, let me jump onto that. Because one of the questions was specifically asked the book value of raised breeding livestock determined. And I guess I'll give a real quick example, but also I would refer you to our guidelines. You can go to the website. They're very reasonable. They're, I think, $30 a piece. They're really, really inexpensive, but it actually walks through that. But what we're doing with base values is there are two ways to do it. One is we can accumulate the costs of raising that animal. Generally in agriculture, we don't have accounting systems that would manage costs to that degree. Some operations do. So the predominant method is using something called a base value. And we approximate the cost that it takes to get an animal raised and then put into the breeding herd. And so that becomes a constant value that we keep for our raised breeding stock. We tend to keep those by different weight classes of species. But anyway, so we could get into that one in more detail, but I think the best thing would be just to refer you to the guidelines.
Perfect, thank you. We have another question regarding business cycles and if there is a benefit to consider identifying a better time of the year, fiscal years versus calendar years for a year end for the business.
Well, I'll take a crack at it, and Todd, you can add to it. In an ideal world, it's nice to kind of have a fiscal year that coincides the end of your normal production cycle. So years ago, we used to see a lot of crop operations that would set up a fiscal year ending in September, October 30th. That was the end of their production cycle. With the proliferation of multiple entities in most family businesses, where there's an operating entity, a lot of times a real estate holding entity, and then you have personal financial information, I see less and less use of a fiscal year that's other than a December 31st. It's very difficult to manage the inter-entity transactions, tax management. So I don't see near the emphasis on different fiscal years other than 12/31. Todd?
I agree with that. I think there are many operations that do set up, certainly on the managerial accounting side, different periods when they would flush their costs to the balance sheet. But being able to get to a calendar year end, because that's how you're going to pay taxes on the personal, right? And so when you're consolidating the the LLC, the partnership, the S corp, and the individual, it's nice to have that on a calendar year basis. Now we have some clients that they do have a non-calendar year fiscal year end, and you can do it, but you have to estimate these values. You essentially have to compute their tax liability twice, right? You have to do it at the fiscal year, but then you're going to have to do it again at the end of the calendar year.
Perfect. Thank you. The next question is regarding multi-member partnerships and how the deferred taxes and buyouts are handled when all members are in different tax brackets.
Well, I'll address that. We talked about that before the session. And in partnerships, the partnership entity itself is not a tax-paying entity. The income is flowed from the partnership to the individual partners in their respective shares. And each partner's share of the balance sheet value is reflected on their personal financial statement. So the liability for deferred tax and estimated tax would be reflected on a partner's personal financial statement, not on the partnership statement itself.
Perfect. And we had a couple of here regarding 1031 exchanges. We talked a little bit about this before the session, and I know you mentioned it kind of in the conclusion, Dick, on the future of 1031 exchanges in the current tax law, and just the odds of those remaining, but with lower amount of gain deferral allowed under the new legislation.
Well, I think funds are viewed as kind of a tax dodge by well-heeled investors. And the reality is, in the farming world, this is a long-established, very useful tool where simple transfers or exchanges of assets amongst family businesses, amongst individuals within a business occur a lot of times. We're involved in a situation right now where the purchase of the farm is involving another entity buying part of that farm and then trading one of our assets for that, so we can group ownership within a common base. But the fact that one of the assets being traded has a basis of next to zero, we're simply swapping land within the same family business, but under the current proposal, we would end up triggering a massive gain on tax when we're not selling anything. We're simply changing assets within a family business. So this is another, in my opinion, just completely inappropriate tax grab. It's going to complicate normal routine businesses, inter-entity transactions that are done in good faith to streamline business efficiency.
Perfect. Todd, did you have anything to add on that? I saw you had put something in there for answering it live.
Oh, no, sorry, I was meant to dismiss. I have no idea about the odds of this. I think I would probably give a nod to Paul Neefer. I think he's known as the ag CPA guy or something like that. Anyway, he posts a lot. He has an article, I think it's in Farm Journal, where he talks about that. I mean, no one knows, obviously, if that's going to happen. Obviously, we don't know what Congress will do. They're certainly clamoring to do something, and it's unfortunate, the unintended consequences of it. But I have no idea whether things like these will actually happen or not.
Yes, absolutely. I think there's a lot of resources out there on what kind of changes we might be looking at in tax legislation and estate legislation. There is several webinars posted on Elsoy Advisors website on that topic as well. So I would suggest checking those out as well. And we've got just about a minute left here before we wrap up. And just kind of as a final comment here, you guys probably touched on it some throughout the presentation, but where do people start when they want to start looking at their deferred tax liability? They know it's an issue, but they just don't know where to start. What would kind of be your wrap up comments as far as the next steps for people to take?
Well, I would say go to fffc.org. I think that would be a good place to start. The guidelines that are available will help. Talk to your ag accountant, tax CPA. I mean, see if they can point you in directions. But I mean, there are consultants, there are tax folks that do work on specifically on ag. Obviously, FBFM, that is their focus. So I think maybe we'll push that to you, Emily. Talk to your FBFM field person. That would be a good place to start for those of you in Illinois. But there are a number of resources, and I would really encourage people to check out the guidelines here. You don't have to read the whole thing. I think just looking at the section on deferred taxes and looking at the Appendix A, I think would be valuable.
Well, thank you guys so much for your time today. We appreciate you being with us. That includes our webinar, Deferred Taxes. Your balance may not be what you think. Please take a few minutes after the webinar to answer our post-event survey. I'd also like to remind everyone that you will be able to view a recording of this presentation as well as access other soybean and agronomic resources on the checkoff funded website, ilsoyadvisor.com. Thank you for attending and have a great day.
Thanks, everyone.
Thank you.